These are 150,000 Tampa Bay homeowners who just experienced something unprecedented in Florida property insurance history. After decades of crisis and chaos, Citizens Property Insurance Corporation, the state's insurer of last resort, shed nearly two-thirds of its Tampa Bay policies in a single year, transferring them to private companies as part of what officials and the Florida Office of Insurance Regulation are calling the most dramatic market transformation Florida has ever seen. But here is what makes this story fascinating. This mass exodus was not a collapse. It was engineered. A deliberate system reset that moved Florida from the brink of financial catastrophe to what experts now call one of the most competitive insurance markets the state has seen in years. And Tampa Bay sits right at the center of this unprecedented experiment in market engineering. To understand how extraordinary this transformation is, you need to know where Florida was just 2 years ago. In October 2023, Citizens Property Insurance held 1.4 million policies, making it the largest property insurer in Florida. Think about that for a moment. A government-run insurer of last resort had become the biggest player in the game. That's not how insurance markets are supposed to work. Citizens was never meant to be a major insurer. The Florida legislature created it in 2002 after Hurricane Andrew drove national insurers out of the state. It was designed as a safety net, a place for homeowners to get coverage when private companies wouldn't write their policies because of high risk factors like coastal location or older roofs. It was supposed to be small, temporary, and shrinking. Instead, by 2023, it had become a financial time bomb threatening every insured person in Florida. Here's why that mattered. If a major hurricane had wiped out Citizens' claim-paying ability when it held 1.4 million policies, Florida law would have triggered what experts call a hurricane tax, assessments on all insurance policies, statewide, including auto, boat, and renter's insurance. Even if you did not own a home, you could have faced massive premium spikes to bail out Citizens. The assessment could reach up to 45% of your premium. This is where the Florida Hurricane Catastrophe Fund, the state's insurance backstop system, would have been severely strained. Mark Friedlander from the Insurance Information Institute put it bluntly. Florida was holding an absolute ticking time bomb of financial liability. Then came Hurricane Ian on September 28, 2022. With winds reaching 150 miles per hour, this Category 4 storm became the third costliest weather disaster on record worldwide, and the deadliest hurricane to hit Florida since 1935. The storm caused over $109 billion in damages in Florida alone, demolished an estimated 5,000 homes in Lee County, and left 200,000 claims unpaid when insurance companies went out of business. Ian was the wake-up call that forced Florida to confront its broken insurance system. The state had become what insurance professionals call a judicial hellhole. While Florida saw just 9% of all homeowners insurance claims in the U.S., it generated 79% of the nation's homeowners insurance lawsuits. Between 2013 and 2020, an astonishing 71% of total claims costs went to attorney fees rather than helping homeowners rebuild. The problem had spiraled out of control through something called assignment of benefits fraud. Roofing contractors would offer free inspections, claim to find damage even when there was none, convince homeowners to sign forms allowing the contractor to file insurance claims, and then sue insurance companies when claims were denied. These contractors could sue without the homeowner even knowing about it. This litigation tsunami drove insurance companies out of Florida and forced the remaining ones to raise rates dramatically. The average cost of homeowners insurance in Florida shot up to more than $5,700 annually, about $3,350 above the national average, making Florida the most expensive state for property insurance, except Nebraska and Louisiana. On December 16, 2022, just months after Hurricane Ian, Governor Ron DeSantis signed landmark reforms into law. Senate Bill 2A represented the most aggressive insurance reform package in Florida history. Starting January 1, 2023, the law banned assignment of benefits for all new policies. It reduced the time for insurers to pay or deny claims from 90 to 60 days. Most importantly, it began dismantling the litigation machine that had made Florida uninsurable. The reforms worked, but not immediately. Through 2023, Citizens continued growing, as private insurers remained cautious about writing new business in Florida. By October 2023, Citizens peaked at that dangerous 1.4 million policy level. Then, something remarkable happened. Private insurers started coming back. The transformation accelerated through 2024, as 17 new insurance companies entered the Florida market. These were not fly-by-night operations. They were established insurers attracted by the litigation reforms and the opportunity to write business in a stabilizing market. Companies that received approval ratings from Demotech, the critical ratings agency for Florida insurance operations, began actively pursuing Citizens policyholders. Citizens launched what it calls the depopulation program, an organized effort to transfer policies from the state-run insurer back to private companies. The program works through what is known as the takeout rule. If a private insurer offers coverage within 20% of your Citizens premium, you must accept it and leave Citizens. This is where Tampa Bay's story becomes particularly dramatic. The region had 234,652 Citizens policies at the end of 2023. By December 31st, 2024, that number had plummeted to 85,248, a staggering 64% decline in a single year. Hillsborough County led the exodus with a 74% drop, falling from 42,607 policies to just 11,060. Pinellas County saw a 65% decrease, but still held the most Citizens policies in the region at 32,208. Even with these dramatic reductions, the sheer numbers tell the story of how oversized Citizens had become. But here is what makes this story complex. Not everyone is celebrating their departure from Citizens. The takeout rule essentially forces homeowners to accept private market offers even if they are more expensive. If a private insurer offers coverage at 19% more than your Citizens premium, you have to take it. This creates anxiety for homeowners who feel they are being forced out of affordable coverage. When those policies come up for renewal with private insurers, rates can spike even higher. The Tampa Bay Business Journal reported that one Tampa-based insurer raised rates about 23% when former Citizens policies came up for renewal in 2024. The human impact is real. Nikija Lynch Escobar, a Fort Myers realtor, described the emotional toll. "It's heartbreaking that you work so hard to get a home, and now it has to go. It has to go because you can't afford it anymore." Some policy experts argue this amounts to discrimination. State Representative Anna Escamani explained, "It's discriminatory to some degree. It continuously creates the opposite of a free market to some degree, where companies can pick and choose who they want to cover and drop folks without any notice, while Citizens is carrying the brunt of potential high-risk and expensive policies." The concern is that private insurers are cherry-picking the best risks from Citizens while leaving the state insurer with the most dangerous, expensive properties. Citizens CEO Tim Serio does not see this as a problem. The term cherry pick is often used about the takeout process, and I would argue that is not a bad thing. These are private companies that are deploying capital, and each of them have different appetites for risk. Citizens spokesperson Michael Peltier explained how this works in practice. Some insurance companies will come in and say, we are looking for homes that are under 5 years old. We are looking for roofs that are under 10 years old. Each company is going to have its own criteria. Depopulation has continued accelerating into 2025. As of January, Citizens held just 395,144 policies statewide, the lowest level in 14 years, and a 50% reduction from the prior year. More than 546,000 policies were transferred to private insurers through the depopulation program in 2025 alone. This represents one of the fastest and most dramatic shifts in insurance market structure ever recorded in the United States. Citizens went from being Florida's largest insurer with a dangerous concentration of risk to holding less than 10% market share in less than 2 years. The financial impact for the state has been enormous. Citizens no longer poses the existential threat to Florida's fiscal stability that it did in 2023. Mark Friedlander called this the biggest sign we have seen thus far to get citizens down to a manageable level of risk. He said we no longer have to worry about the so-called hurricane tax that would be a surcharge applied to all Florida consumers. But questions remain about the long-term sustainability of this transformation. A November 2025 report from the Insurance Fairness Project warned that many of the new insurers taking citizens' policies are small and undercapitalized, politically connected, or linked to previously troubled companies. The report argues that homeowners dropped from citizens may end up worse off unless accountability is made a priority. The real test came in 2024 when Hurricanes Helene and Milton struck Florida. Unlike previous major storms that drove insurers out of the market, these hurricanes did not trigger a new crisis. The reformed litigation environment and stronger insurer finances helped the market absorb the losses without the chaos that followed previous storms. In December 2025, something unprecedented happened. Citizens' Board of Governors approved the first rate decreases since 2015. The recommendations call for a statewide average rate reduction of 2.6%, with 3 out of 5 citizens' policyholders receiving an average premium reduction of 11.5%, or $359. Governor DeSantis celebrated this milestone. He said Floridians are seeing rate reductions in both auto and homeowners insurance across the state, with additional relief coming soon. The reductions in citizens' insurance rates are the most significant in recent memory. Premiums are lowering because we have enacted real reforms and withstood the pressure to reverse course. The litigation reforms have shown measurable results. Property and personal lines litigation dropped by about 25% in the first half of 2025 compared with 2024. This has made insurers more willing to write business in Florida again, and has begun bringing down the cost pressures that drove the previous crisis. Tim Serio, Citizens' Chief Executive Officer, credits the legislative reforms. He said critical reforms championed by Governor DeSantis and approved by the Florida legislature have done what they were supposed to do: provide rate relief to policyholders and stability to the Florida market. The transformation has also affected Tampa Bay's real estate market in unexpected ways. The price of the typical home in Tampa Bay fell to $362,150 in June 2025, a nearly 6% drop year over year. While multiple factors contributed to this decline, insurance costs and availability played a significant role. For properties requiring flood coverage, homeowners often need both wind insurance, either from Citizens or from a private insurer, and flood insurance through the National Flood Insurance Program to meet mortgage requirements. Pinellas County saw a 5.5% price drop, partly due to hurricane impacts and the general market slowdown. Many storm-damaged homes are selling at land value, dragging down average prices by up to 30% in some areas. The ongoing insurance challenges make it difficult for buyers to find required coverage for mortgages, complicating real estate transactions. Yet there are signs of stabilization and improvement. Florida has launched the My Safe Florida Home program with $280 million in new funding for 2025 to 2026. The program offers free wind mitigation inspections and matching grants for homeowners to harden their homes against storms. These upgrades can lead to significant insurance premium discounts, creating incentives for resilient building practices. The program represents a shift toward addressing the root causes of insurance costs rather than just managing the symptoms. By helping homeowners make their properties more resistant to hurricane damage, Florida is working to reduce the underlying risk that drives high insurance costs. Looking forward, the question is whether this dramatic market reset can be sustained. Citizens now holds 395,144 policies, still substantial, but no longer the systemic threat it was at 1.4 million. Private insurers are writing new business in Florida for the first time in years. Litigation has declined significantly. Some insurers are even cutting rates. But Florida remains a high-risk state for natural disasters. Climate change continues to intensify hurricanes and increase storm surge flooding. Sea level rise threatens coastal properties. The fundamental risk factors that drove the original crisis have not disappeared. They have been managed through policy changes and market restructuring. The Tampa Bay experience illustrates both the promise and the peril of this market transformation. The 150,000 homeowners who left Citizens represent the largest transfer of insurance risk from public to private hands in Florida history. Some will benefit from increased competition and eventually lower rates. Others will struggle with higher premiums and reduced coverage options. Congressman Maxwell Frost captured the ongoing challenge. He said, "Florida's property insurance crisis is pushing families to make impossible choices. I've heard from Central Floridians that they are foregoing coverage altogether because they can't afford both health care and property insurance. It's a shame that the property insurance crisis has put folks in this position." The story of Citizens' Tampa Bay exodus is ultimately about more than insurance. It is about how societies adapt to increasing climate risk and whether market solutions can address challenges that threaten entire regional economies. Florida's experiment in forced privatization and litigation reform represents one approach to this challenge. As extreme weather becomes more frequent and severe across the United States, other coastal states are watching Florida's experience closely. The success or failure of this market transformation could influence insurance policy nationwide for decades to come. For the 150,000 Tampa Bay homeowners who experienced this transition, it represents both an ending and a beginning. The ending of a state-dominated insurance market that had grown too large and too risky to sustain. The beginning of a new era where private markets, reformed regulations, and individual resilience investments must work together to keep Florida insurable. Whether this new system can withstand the next major hurricane while keeping coverage affordable for middle-class homeowners remains the ultimate test. The Tampa Bay depopulation story shows that dramatic market transformations are possible, but it also reveals how much uncertainty and anxiety such changes create for the families living through them. The reset is complete. Now comes the harder task of making it work for everyone who calls Florida home.